Hi, I'm going to say something a bit controversial that might offend some people, but I personally believe, and I believe it because of my experience, that mechanical trading is way better than trading ICT concepts, smart money concepts, or supply and demand, or for that matter, most of the trading strategies that are available online, whether it be reversals or continuations, simply for people who have been in the market for less than 2 years. And I'll explain what the problems I have, and then I'll explain why mechanical trading is better, and I'll explain it with proof and with my own model. And so let's just get into it. So I traded ICT concepts for the first 1.5 years of my trading journey, and I faced a lot of issues. And most of those issues are, available online. People telling you and this and that. I wanna say something which was the most critical thing for me, and I'm assuming that for a lot of people who are trading ICT concepts are going to be facing these issues as well, who have been in trading for a year almost, trading ICT concepts. Those people are instantly going to recognize that what I'm going to say is going to be very logical and very true. So the first problem that I have with ICT trading is the interpretation of the market. What I mean by that is, since there is no fixed rule, everything is open to interpretation, and there is no way for a beginner to actually learn what mistakes they make or were they right in taking a trade. And I'll give you an example. Let's say you are getting trained by um, two mentors, even though you should always have one, but just for the basis of analogy, you take a trade and then you bring that trade to your two mentors. Both of them trade the exact same ICT strategy or the exact same supply and demand theory. So you would bring it to them, and then they would say, one of them would say, and suppose that this was a loss. So you want to make sure this loss was valid or not, and you bring it to one of the mentors, and he says, no, this loss was not valid because of this confluence, because there was this little order block here, or this fair value gap, and this is why you should not have taken that trade. And you bring it to the other one, and the other guy would say, yeah, this loss was valid, the liquidity had been taken, we inversed this fair value gap, and we were supposed to go up but we didn't, etc., etc. And same thing with the winners. You would bring the winners, and one would say, you just got lucky, you were wrong, and then you just got lucky, and this is not how you should trade. And the other one would say, yeah, I see nothing wrong with this trade, this is a completely systematic win. And this was the problem that I had for the longest time ever. I wouldn't know if my trades were valid, or were they losses, or were they winners. And I was like, in this vicious cycle, um, and never knowing, am I actually learning something, or remember, I got payouts in this time as well. So it's not just that I was just trying to do this on evaluations. Even though I was trading ICT, I got payouts, but I was never consistently profitable. And I want to say this again. It's not that ICT strategies or supply and demand don't work. My argument is that people should not start there. People should not get into the market trading ICT concepts when they don't even know the basics of what trading actually means. This was my first issue. And the second issue is that simply most of the traders that are learning right now for the past 2 years have been doing so that they would go on to trade prop firms. And these supply and demand smart money concepts and ICT concepts, most of them are not simply designed for trading prop firms. Why? If you go and study prop firms and look at their statistics and look at their business model, because they are designed in a way they want you to fail, right? Everybody knows that. So how are they using it? They are using it, and if you look at their statistics, people that are trading um, 1 to 2 RR, even though a lot of people I know trade more than that. ICT concepts are basically reversals trying to get big moves in the market. And if you are trying to do that, you will be wrong more than you'll be right. But since the RR is so big, it on maths you are profitable, right? On paper you are profitable. What ends up happening is that the you are in this vicious cycle of buying and failing evaluations, or passing and blowing XFAs or any of the programs. And because your equity curve looks like this, you go up a bit, then you drop down a bit, you go up a bit, and then you drop down a bit. If you get lucky like I got in some of the cases, then when I was going up the big moves, and when I was right I got a payout. But most of the people will never, because it's simply not designed to perform in a prop firm space. If you were trading it on your personal account like TGR does, basically, then it would make sense. If you have $1,000 in your account and you're risking 50 on each trade, and whenever you win, you make $200. Yeah, you should be profitable. But on prop firms, the big drop comes, you are wiped out. Now you are back again at passing evaluations. This is their business model eventually. Now, enough of the ICT and the problems, even though there are a million others, but these are the two I think a lot of people miss. So let's get into why mechanical trading is better than this. So my mechanical model, the logics that it's based off, I don't think so there's a trader in the world that would disagree with me on this. And the first aspect is that my model is based on human psychology. The market is based on human psychology. The algorithms that are in the market are based on human psychology, and human psychology does not change. So if your model is performing right now, it should be performing in the crashing markets of 2008 or in 2000s or even before that. So that is the number one aspect of my model, that it is a model that would not just fade away with time because it's based on human psychology. The second thing is the strength continuation. So the strength continuation means that we're looking at a very minor scale. We're looking at what's happening in the market for the last four candles. What's happening here? One, two, three, four. Markets consolidating, and it does not want to go up. This is what I uh, see when I look at these four candles. One, two, three, four. Markets consolidating on a very minor level, and then it tried to break out, but it did not, and we sold off very quickly. And this is what I mean when I say strength continuation, or on a minor scale, this is what's happening, and this is what we want to look at on 1 minute time frame. I'm here on 1 minute time frame, and we are looking at minor price action or price structure. So on this structure, market prints a candle which is strong. By strong I mean it has a big body and a little to no wicks. For example, let's say this candle, right? Market was what's happening in the market. On a minor scale, we are consolidating. We tried to break out, but we got bought up, and then sellers went all in and printed a strong candle with little to no wicks. This is strength in the market, and I am betting that it's going to continue in the same direction for me to get a quick scalp, and that's exactly what happened here. This was my first trade of the day, and this was a winner. So this is what I mean when I say strength continuation. The third is we are reacting, we are not predicting. We are not predicting that is this liquidity going to get taken? I'll be way out before that. We are not predicting if the market is going to break this consolidation. We're not predicting if the high time frame gaps are going to get filled or the liquidity is going to get taken. No, we're simply reacting on a very minor scale because we are scalping. So that is point number three. That's third logic my model is based on. And fourth is simply market sense. What I mean by market sense, I'll show you with an example. For example, everybody knows that market moves in trends. Market does not just simply go up or simply go down. So this is generally how market moves. Everybody knows that. This is one very very small example of market sense. The other one would be, for example, let's say there are five straight red candles, one, two, three, four, five, and they're big. It's very unlikely for the market to print another red candle, and if it does, on the seventh, the probabilities um, are even lower, and if it still does on the 8th, the probabilities are even lower, because market doesn't just simply fall or doesn't just simply go up. It needs to get a pullback and then continue, or either reverse. So that those are the four core logics my model is based on. The statistics that I have with this model on 500 trades is I have 65% win rate, somewhere between 65 to 70%. My RR is fixed. I'm a quick scalper. I need 1 to 1 RR and then I'm out of the trade. And the strength of my model does not lie in these two aspects of my model. Even though a lot of people, I think, almost all of the main, mentors and stuff, they want to focus on these two. I have a high win rate, and I have a lower RR. I have a 1 to 5 RR, and I have 40% win rate. And simply forget the third aspect, which is trade frequency, and this is where mechanical trading comes in, and actual scalpers. You think actual scalpers take one trade in a week or one trade in a day? Imagine, like, just think about it. Do you think that institutional scalpers basically take one little scalp in a day? Do you think that is what they do? I don't think so. And this is the strength of my mechanical model. I usually get somewhere between 8 trades every day. On average, sometimes there are more, sometimes there are less. Very improbable that it might be less than 5, but it has to be. Most of the time it is above 5, and it goes upwards of 12. Today I got 15. It was one of the best days in my trading journey so far, trading this model. And then there are principles, how you look at mechanical models. I don't think so there are a lot of mechanical traders online that are teaching actual mechanics of in how markets move and actual mechanical trading. I don't think so. A lot of them are out there. So the principles when it comes to mechanical tradings are, you've got to look, because of the trade frequency, you've got to look at the model on 100 trade basis. If you want to be more conservative, the numbers can go as high up to 500 trades, but like on 100 trade basis, which I would get basically in 1 month, I can look at what my statistics are, if my win rates dropped or if my frequency is increased or dropped. And basically this eliminates a lot of psychological issues, like for example, the psychological issue of getting FOMO, right? I don't think so it's even possible to get FOMO in this trade, because most of the time we are in the market taking the scalps. Uh, but you've got to look at the model on 100 trade basis. The second aspect of the model is the second principle is mechanic skill psychology, and this cannot be more true. If you are trading mechanically, if you know exactly what you need to do, it's like 1 plus 1 is equals to, you not being discretional. Is this one, is this two, is this, you understand what I'm saying, right? It's simple mathematical formula. 1 plus 1 is equal to 2. Whenever that happens, you get into a trade, and fixed stop loss and fixed take profit. And this kills a lot of psychological issues people face every day. And then there's room for error. And this actually might be the only reason I was unprofitable using ICT concepts, is that I used to trade continuations. I didn't trade reversals. I think continuations are way better than reversals, even in ICT concepts. And you will be more right than you will be wrong. And I had somewhere between 75% win rate, and still I was unprofitable. And the sole reason was because I had no room for error. My trade frequency was like 2 trades in a week, 8 trades in a month. I take 8 trades on average on a day now. So 8 trades in a month. If you go break even early, and it was supposed to be a winner, now your win rate has dropped by 15% or 10%. You make a mistake, now your win rate's dropped by 20%. Like if you make any mistake, and if you take a trade that you were not supposed to take, and so now it's 30%. So the 75% win rate is now back to 45% win rate with 1 to 1 RR, and you are in the negative. There is no room for error, and this is why I say mechanical trading is way better than ICT concepts for people who are starting out or who have been in the market for 1 or 2 years, because you will make mistakes. And yeah, if you make mistakes with ICT concepts, you will never be profitable. But if you did make mistakes mechanically, you might be. So these are the logics, principles, and problems that I wanted to lay out. Now let's just quickly go over today's trading day. Today is March 13th, and this was yesterday's trading day. This is one of the like good days that I had with this model, and I got 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15 trades. Out of those 15 trades, 1 2 3 and 4, these little crosses um, show my losers. So 4 were losers, 11 were winners. I netted about 7 RR. And if you look at this, and this is what I mean. A strong candle with no wicks here makes sense. We are reacting, and we got a quick scalp of 1 to 1 RR. Same thing here, big candle with little to no wicks. We got a quick RR. Same thing here, exact to the teeth, 1 point. Exact to the point, I got 1 to 1 RR. Same thing here, it went on a little bit down, but I got out on 1 to 1 RR. This was a strong, small candle, but it had little to no wicks. It indicated strength and it made sense here, but it was a loser. This was again a winner to the teeth, 1 RR. Again here, winner, winner, loser, and same thing continued. I trade from 9:30 to 12 o'clock, basically one full session. And these are the results that I have. With January, I have got um, so January first week was off, as you guys know. I started trading on Tuesday. Fifth was also a loser. Actually, it was like minus $700-800 here. I risked $500 on each trade. So other than that, the whole you can see month with 2 red days, and it was $17,000 at the end. If you sum it all up, and this is 3 weeks, not 4 weeks. In February, it was something similar, somewhere between 19, and March is going pretty well. And so this is my model, and this is why I think mechanical trading is way better than trading ICT concepts, or for that matter, most of the trading strategies that are available online. If you want to get that strategy and like automate it and run it, I've done that as well, and I've been profitable on a very larger time scale. 5 years, last 5 years, I was highly profitable. There was a year which I was not that much, but nevertheless, this is a trading strategy, and this was my first ever YouTube video. Please feel free to like it or subscribe. And I've made a free Discord community in which you can go and ask me any questions that you want, and I'll be happy to answer those questions. Thank you so much. I'll make a new video back testing the strategy live, my model live, and then hopefully that helps a lot of people, because that is my goal here, to help struggling traders. Let me know if you have any questions. Feel free to drop any questions in the comments. I'll be replying to each and every one of them, and you can link up with me in my Discord as well. The link will be in the description. Thank you so much.